Hello everyone. Excited to kick off this live. We're going to go through a few things today. And the number one is going to be this deal that I have in question. I get asked all the time, can you do more deal reviews? What does your weekly deal review look like? Can you share active deals, things that are in progress, and give us insights to what they look like? And that's what we're doing today. It's been a while. I think I originally hosted lives the end of 2020. At that time, we had just closed 3 acquisitions in 90 days, and I was getting, let's just say, pressure from a variety of networks I'm a part of to share what that looked like. And it was very helpful for many to go through the deals with me and to give insights to it. And so that's our goal for today. We're going to walk through a deal that we have under LOI. We're going to unpack the process from sourcing that deal to ultimately getting that LOI signed, and then take questions around it. And I have had a few already submitted to me that I teed up for us. Hopefully we can answer all your questions in the time that we have. And if not, feel free to reach out to me. Just for some baseline background, I'm Peter Lang. And since 2019, I've acquired 13 agencies, from small companies ranging from 300,000 in revenue to pretty sizable companies, up to 3 million of EBITDA. I stay in this Main Street, lower middle market category, as I've really figured out a sweet spot of how to interact with that marketplace and then transact pretty efficiently. And I've deployed that engine of sourcing these deals and closing them across a suite of my portfolio that includes AVA, so it's Agency Ventures Aggregator, our boutique private equity firm that's acquiring agencies, as well as within my partnership agencies, so companies I have a minority stake in and I'm investing in them to grow, and we're doing M&A to help them grow. So this journey has really enriched and informed my expertise around M&A and the landscape of scaling businesses and service businesses. So today I'm excited to share my insights with you, answer any questions that you have around acquisitions, and hopefully use this deal as a use case that gives you greater confidence in doing your own deals. So let's start by doing a quick review of this recent LOI. The deal first came available through a broker. I teach it, I promote sourcing directly, and I say be wary of brokers, but I still do the broker game. I think it's important to see what's available. There's a few primary players that exist within the marketing services space. Be familiar with them, and if you can transact with them, they become positive in your favor for how you approach the market. So in October of last year, it was October 7th to be specific, made contact with the broker about a listing that they had. And I typically immediately go into the conversation saying, I want to speak to the seller. And this is like a general, what I call connect call in M&A, where you're just trying to figure out if you like the seller, like the frameworks around the deal. We already have a confidential information memorandum. So we have the SIM. We already have some data room prepared that gives us a preliminary snapshot of the business performance. And really, what's the motivations? Why are they selling? Especially for such a small business. What does the owner want out of it? And do I like them? The number one qualification that I always approach every deal is, do I like them? This is someone that I'm going to have to do a deal with, negotiate, disagree with, but also build a future for. Life's too short. You got to do it with people you like. So we had that first connect call, do I like you call, on October 9th. And this was before I really knew which platform or which company was a good fit for this deal. I have so many agencies that I'm always trying to fit the narrative or the purpose or the deal thesis of a specific platform when talking with prospective sellers. And I have so much deal flow that if I don't have an opportunity today, I have to pass or share it with someone in my network. And in this case, it went really well. Really excited by the motivation and enthusiasm behind this young entrepreneur, what they're trying to build. They've gotten to a certain point of size and scale of critical mass for their role and their capabilities, and they're looking for being a part of something bigger, which is a great opportunity for a lot of the compositions of my platform. The next call, which we call a business deep dive call, and this is my favorite call. So whenever I build a programmatic M&A engine and I put a team in place to source deals, I'm always telling people they're going to learn so much through the BDD calls, so business deep dive calls. This is when the seller, and in this case, the broker, hopped on a call and we went through in detail the seller's business, how it operates, how they manage and hire people, what the clients are like. And in this call, and I have a playbook at this in my Mastering M&A course, you're trying to find out how many hats the owner wears. How much of a bottleneck is this owner? So on October 30th, we did the business deep dive call. And this seller had a lot of hats. I think it was in total 6 or 7 hats. So you can think the salesperson hat, the head of HR, the head of IT, all of these roles, never mind the client-facing roles, head strategist or the project manager. These are typical hats being worn by people running small businesses. And this business is small. We're talking revenue around 656,000, SDE calculated through the broker around 400,000 in profit. And so really a highly profitable little company. And although in isolation, there's a lot of risks inherent with an owner wearing that many hats and that small of a company, because obviously it doesn't have middle management, there is a place for those types of deals. There is an opportunity to transact with those types of sellers. And so having the right platform, having the right place in mind for that is key. And that's what I'm able to figure out on that business deep dive call. So that was October 30th. And then on November 1st, right away, we're like, we like it. This sounds interesting. Let's get some more financials. Let's go further down the interest line before committing any stated price or terms or what our offer would be. And our assistant sends out that request. And from there, we're able to get a pretty good snapshot. But we're not done. In order to do a deal, we need 2 things. We need a narrative, and then we need the numbers. Far too often, people are pushing the numbers without having a narrative. What's the strategy that this acquisition is enabling or helping us to achieve? And so on November 8th, we did this strategy call, which is typically the step after the business deep dive call. And it's plain and simple. What narrative do I think I have that fits this seller? What's the home going to be? And so I pulled in one of my business partners who runs one of our agencies and said, all right, you're going to meet them. You're going to introduce yourself. You're going to run our strategy call playbook. And we're going to figure out, is this a good deal for your platform, for what we have going on in your agency? And if you tee it up properly and you have the right narratives, those calls sing. That's where the seller is more excited about the person they're meeting who's going to be their boss, who's running the agency they're going into, than even running their own company. And that was the outcome of that call. It enabled the seller to see what it's going to look like after the deal is done, from a day-to-day, from a how is this agency going to run, how are we going to get clients, how are we going to collaborate perspective. And that's when they get really excited about you as a prospective buyer. That's how they get excited about us. Now, I teach a very lengthy pre-DD process or pre-offer process, mainly because most people aren't prepared to hear price and terms. They haven't figured out fit strong enough to justify any deal structure. And so I think it's the buyer's responsibility to invest time and energy, as well as the seller to reciprocate, providing the information necessary for us to understand fit. And so we do this after the strategy call through an audit. I designed this agency audit. It's about 126 questions. I teach it as a part of my M&A Mastering course. And it's all about the seller sitting down and writing out everything that they can to share with us as a prospective buyer about their agency. It's an audit. just by completing the audit, they're going to learn things about their business that they hadn't considered that will increase the value of it. So it's really worth them going through, but it is a time suck. It takes anywhere between 4 to 8+ hours to complete, and it's pretty intense. Asking the things that most small businesses don't have, which is really important, because to get a deal done, there's a zone of fairness. Where we are versus a buyer and a seller is sometimes so far apart that we're trying to get within the zone of pragmatic, realistic expectations for this business. And the selling process doesn't always foster it. So the audit helps focus the conversation around the bits of the business that are really challenging. And so we sent that audit out on November 11th, and we said, okay, well, let's get it back. Let's take a look at what this seller thinks about their agency. And at first glance, the seller didn't give us a lot of meaningful detail. And that's a signal to us. We often say the length and breadth of the completed audit shows us how motivated a seller is for us to understand them. This is a tool, right? Especially post-COVID, there's not really an enthusiastic M&A, I'm going to travel and meet and have dinners together type of energy in deals anymore. Everything's become really efficient and effective. How can we systemize communication so we can get to a deal without really disrupting the business or disrupting lives? And we asked for more information. We were not really satisfied with the completion of the audit. And from there, we're pushing back right away. And November 14th led to this whole preliminary financial due diligence being completed, which was we asked for more financials. We asked for a greater picture of the business than provided by the broker. We had them complete an extensive audit, and ultimately felt we learned enough to make some findings and some recommendations. So within this, we have things like revenue trend. We were looking at the advertising expense and how they were treating it as a company. We looked at the labor expense. Obviously, a company that is this profitable is offshoring or has some great efficiencies in regards to their contract labor, and which they did. A lot of it was outsourced labor or offshore. We looked at some of the professional fees that were, discounted or adjusted out as one-time expenses, and kind of challenged those in regards to ongoing operations of the business. And then the big area with a lot of broker-led deals, or just deals in general, is the add backs. What is not counting towards the EBITDA, and things like travel, meals, property, cars, telephones, all these types of things that, although there are costs within the business, even from an ongoing perspective, the seller often adds them back as it's not a reflection of earnings. This is where some of the challenges come in on these deals. We looked at the valuation being presented by the broker and thought there was some differences from our approach. And then the quality of the books, that, the way the chart of accounts was being run and the overall quality of the numbers we took issue with. And from there, we're able to do a P&L analysis and look over year, trailing 12 months to get what we felt is a good or a strong understanding of the company. And ultimately we did. And we approached this business with a non-really disputed enterprise value, but there seemed to be something flagging it. And so we wanted to hit this topic on the head with the seller, which was there was some technology build out, some proprietary tech to support the contractor management that was being deployed in the company. And that, although it was not really built into the revenue model because it was only being used by the service firm, we knew those efficiencies were being realized in the business, and there was an objective to take this software to market at some future date. So we said, okay, well, we understand that the current value of the business is based upon its current efficiencies. There's a software component that we won't own. We don't want the software. It's something that we're not interested in. So let's carve that out of the value. So this gave us a enterprise value at 1.3 million, then a reduction of about 30% of that to carve out this tech. And that gave us really a reduced or adjusted valuation to 910,000. So when we were looking at the business, we said, okay, well, for 910,000 for a business that adjusted earnings at 450 and 22,000, we're getting in a realm we're a little more comfortable with. But brokers love to, at all sizes of businesses, tell their clients that they'll get significant cash on close. They're often proud of it because they're usually compensated from the guaranteed payments or the cash component. And that was locked into this seller's mindset. 40% at the floor of expectation of cash on close, which for a business like this, so many owner bottlenecks, it just doesn't make sense. So we knew this was going to be a hurdle for us. So we jumped on, and we call it the deal structure call. Now keep in mind, it's a lot easier to talk about deal structure, what you're willing to pay for a business that you understand, versus something you're just reading in a CIM. If you're just reading a deal for the first time and then hopping on and giving loose terms based upon almost no details about that business, the seller's not going to get it. The seller's not going to feel comfortable with that. So you have to invest preliminary due diligence time and energy to understand the business as best you can, almost in greater detail than the seller themselves, because you understand the issues that you uncovered in the audit and the future capabilities of this business. So we hop on, we do a deal structure review call. And this is with the CEO of the platform that we're going to put this company into. It's with the seller, with the broker, and we go through the details. And at first, in French, we say, zut alors, the seller's shocked that they're not getting a 40% cash on close presented as an offer. And you go through and state why. And for us, we initially started with a cash on close offer at 10%. And we knew that this would be an area that we could potentially give on. But we knew that it for sure was not worth anything north of 20. 20 would be the max you could pay for a business like this, given that it's a self-financed deal, already attributing some level of discount associated with some efficiencies that were brought in by the technology, as well as we knew there would be a rollover component. So we laid this out. There's going to be cash at close. There's going to be a note payable over a few years, and there's going to be a subsidiary with this asset sitting in that the owner could have some residual ownership. So when he participated in the eventual exit of our platform, which was scheduled for the next 3 years-ish, there would be a second bite of the apple and even potentially a third bite of the apple, which is really important when looking at small deals like this. The first transaction at that size is usually not life-changing. It's an investment in what you're building together. And we made some loose calculations. And this loose calculation, although it's a part of a deal structure template that I teach, came to a total that said, well, if everything you say about your business is true and it performs to the expectations you would like us to have, this is what it means for you from an earnings perspective over this period of time. And so that meant total estimated earnings that include the exit at the future divestiture of the business, so the rollover equity being converted, plus to some degree taking into account a salary that's earned over that period of time. The total earnings to the seller was going to be 1.7 million. And this is significantly above asking. And when I teach programmatic M&A, I'm trying to make sure that departments and the deal people know our job is to give the sellers what they want in a way that we can quantify a multiple of return. Give sellers what they want in a way that we can quantify a multiple of return. If you can't do that, why would they choose you over the status quo of keeping the business? And so we were able to paint a picture of saying, here's the steps, and walk them through those steps that show how that total earning potential can be realized. And when you compare that to what they're making from the business over a 3 to 5 year period of time, they're going to make substantially more than if they just ran their business. And given the threat of AI, the uncertainty of global markets, currencies, all the sorts of macroeconomic events that really make it hard to project, especially in the digital agency category, longer than 5 years, we seem like a more sensible bet than even keeping the business as it is. So this Initial cash at close percentage was at 40, got it down to 20. The note payable period then was extended. And this deal was going to be in a construct of a 30% rollover. So let's do the math on that. The rollover equity component is sitting in a subsidiary. And great question, Mark. So I'll touch on it here, which is when you're building a platform, you have multiple ways to hold assets and to incentivize people for the future outcomes. In most roll-ups, traditionally, there's a single platform and you're trading the equity of the parent or of the platform. And that's consistent. I did that for many years. You'll also see great use cases of that, but also some negative ones with S4. And I highly recommend going and seeing the publicly listed businesses, the companies. Their information is available. They have to file. So you'll be able to see the workings of these deals and how they played out over time. But most of it goes to the narrative you're building and how you can tie performance. Can you have a separate P&L? Can you track the profit contributions and client contributions at a single entity level? Yes. How I prefer to run it and how I've built aggregators to execute it, and this is kind of like aggregators in general are built this way. It's different than a roll-up, is you have a platform company. This would be deemed potentially your holdco, and you have subsidiaries that are the operating businesses. So subsidiary 1, subsidiary 2, subsidiary 3. The term micro roll-up starts to come into play when you look at acquiring into those subsidiaries versus the parent. At the end of the day, when you're valuing a business, it's going to be off of the consolidated financials, not the fact that you've isolated liabilities and performance into subsidiaries. That's not going to be a challenge. What it does allow us to do is separate, though, employment liability as well as the asset liability into subsidiaries that could be divested if they underperform. So if I were to use my hands as a visual here, parent on top, subsidiary 1 below it, and then I drop one more subsidiary below that. Why do we do this? Well, in the vast majority of deals, what we're trying to do is gain the revenue generating assets and divorce them from their liabilities. And so I'd like to place all those assets into an entity that is tied to the transaction if there's a future underperformance. Meaning, if this company doesn't perform and I have to unwind the deal, I have to divest it, I just have to carve out that asset. It's not commingled with a variety of other assets I've acquired into the operating business. Begin with the end in mind. Plan the organizational structure not to be perfect, not for everything to work, but what if it doesn't work, and how best could you divorce or separate those assets and carve them out in the future? So that's the typical 3-org structure that I recommend in aggregation. And that's what we're doing here. So we have an operating business that is our platform. We're doing one entity below, and that's going to hold this seller's firm. And they're going to have 30% of that P&L, of that entity. And they're going to have rights with that, not voting, but they're going to have disclosure. They're going to know what's going on in the business, because that will make them feel more comfortable with where the company is going. The deal structure call got the typical thing. If you ever think someone's going to be excited about the structure you propose, you haven't done enough deals. The vast majority of the time, sellers are not prepared for what you're proposing. And they've heard a variety of different things as expectations. And so they step away and they have a conversation. They usually talk to their significant other, talk to the broker, and the broker then emails over a counter. And you look at this counter and you go, well, that's exactly like the polar opposite to what I just proposed on the call before. Let me clarify. I do not advise people to write the responses. In a deal, it's a very emotional situation for the seller. I then say, thank you for your email. Let's hop on a call to discuss. And you jump on a call. And you talk with the broker first, if that's the good representation, meaning it's someone that the seller really respects and you think you can have a productive conversation. But then ultimately the seller comes on and we walk through the reasoning behind our deal structure. the reason we feel this is appropriate given what we understand about the business. And we do it again. And you repeat yourself quite frequently. And they try to ask for areas for you to give or make additional concessions so they feel like they've taken something from the deal that's positive. And hopped on, and we did. We went from 10% cash on close to 20%. Now, when you're talking about a business at this EBITDA, so 400,000, and factoring in that we already did a 30% reduction because of the carve out of technology, I was really looking at plus or minus 90,000 to 130,000 cash on close. Not significant, but also nothing just to wink at. So the main bit then we have to rationalize is what do we think we will do with this asset? So if we're going to put this much capital or this much money into this deal, no matter the size, you can add zeros to it. It's the same logic. What do we think we can create with it? Now, that's not a gain that the seller gets, but that shows us from an investment committee and decision-making perspective that we're willing to put that money at risk because we feel like we can do this with or do things well with this asset. Went back and forth mildly, and a lot of the final questions started to pertain to post-LOI questions like salary, my responsibilities, what's the day-to-day going to look like, what's the composition of the current team, and how do I fit in it? We already knew the seller was mentally into the deal because they've already transitioned out of the deal terms to day in the life. What's it going to look like? So we finalized that deal structure and sent it over, then got it signed. That from the discussion with the broker on the counter offer was January 4th to the signed LOI was January 26th. Now, could this have happened faster? Because it was about a little over 100 days. Yes, but was it also during a holiday period? Was it also in our favor to evaluate it properly with the other deals we're constantly looking at? Yes. Sellers don't get told this by brokers, but the speed to which you execute shows your interest and your enthusiasm for a deal. Time is on the side of the buyer. We're given a snapshot of this business today with some future expectations. If I can hold the deal long enough to see if those future expectations really happen, I feel like I can approach a deal with more fair and pragmatic structures, whether it be it continues to perform or starts trending in a different direction. So what did it ultimately look at? Well, I'll use the numbers here. So we had 910,000 was the ultimate enterprise value being applied after the reduction of what we call a software carve out. Cash at close ended up being 20%, and that was 127,000. And then because we ended up going from 10 to 15 to 20% cash on close, we adjusted the note that was going to carry the remaining percentage, and it's amortized. So we had a note payable for 4 years for the remaining percentage, sans the rollover. That came out to about $10,000 a month. And then the seller was going to retain 30% in the go-forward pro forma entity. And this seller was getting a salary of $210,000. And when we calculated the future EBITDA with some growth expectations by this company, their next bites of the apple would equate to potentially in year 3 and year 4, 150,000 in year 3 and 150,000 in year 4. That's because the next buyer, especially the ones that we're talking to, are going to ask that rollover equity partner to roll again. So they have vested interest in their acquisition and their deal. So that's where the current deal that we're operating at now is sitting. And I had some questions. So let me go through some of the questions that have come through. One was, what are some of the deal killers to look out for in due diligence? There's deal killers at various stages. So in due diligence specifically, so that's after LOI, we break it into 3 phases. In phase 1, which typically takes about 2 weeks, but can be elongated to a full month, it's really critical business issues. So if I see a disparity between what they shared with us in pre-DD and what I'm seeing in due diligence, red flag potentially could kill the deal. I want to see as much continuity between the things that have been disclosed and represented throughout our conversations to the back end. I won't always kill a deal because obviously most businesses are messy and some things just become more clear as they're cleaned up, but it's definitely a really critical one. The next one is going to be these client contracts. In service businesses especially, I'm extremely cautious around contracts. I'm paying present value for future expectations. Now, if I can tie my deal to future expectations, I'll have more flexibility with how much I scrutinize contracts or scrutinize contracts as it relates to the value. But ultimately, I need to know that those are assignable. So non-assignment provisions are really critical. And I've usually vetted that out in pre-DD. And if so, I say, okay, well, what's the likelihood of these clients liking the new buyer, liking us coming in and you potentially being out? And so that's a big one we pay attention to. The next one's key employees. If the people you're paying as a seller are under market, I have massive concerns around adjusting the financials to reflect their expectation of being paid more. So much of this is about maximizing the EBITDA, so then they can apply a multiple to that on valuation. But once you've underpaid your current people, once they hear about the deal, they're going to want more money. And you have flight risks because of that, which is a massive concern for me. So those are the big ones. Also look at anything that is critical to the ongoing liability. So like facilities, if the owner owns the building that they're currently leasing back to themselves, I look at those things. I look at the rates that they're paying. Sometimes it's used to move money up. But that's all. I give you the basics for asset deals. So in an asset deal, when I get to separate or divorce a company's revenue from its liabilities, I'm not as surprised by deal killers in due diligence. Due diligence becomes integration planning. We're really working to map what the next state of this business is in our ecosystem. And so due diligence is about requesting all the things that we need to request for the asset purchase agreement anyway, in the schedules. Those are things that are submitted, things we actually buy, and then verifying that those things are true. And then based off of that, building a plan and a roadmap to manage this asset or manage the team or the clients moving forward. So there's not too much that can kill a deal for me and for the way I approach deals because I had such an extensive pre-DD process. When it comes to acquiring the shares of a business, when you buy the past, current, and future liabilities, there's more to scrutinize. I bring in teams for that. That could be a financial partner like Centurica to do the quality of earnings. I'll bring in my law firms to make sure that the corporate organizational structure is more on par. I have a more extensive list there. Great question. Were you able to put the profit goals tied to the note payable guarantees? Yes. So a dollar for dollar reduction of payment based upon EBITDA performance is what we built into this deal. At the end of the day, it doesn't help the seller if the company starts to underperform. So COVID hits again. Hopefully not, hopefully never. But if COVID were to hit, we wouldn't want to be in breach because the clients dried up and we didn't have any money to pay the note. So it's very sensible now to say, if we don't make the money we expect, then you have to give us the flexibility to not be in breach. So let's figure out a formula and a look back period that is fair so we can pay you what you want to get paid and us not be penalized from it. And ultimately, there's ways to get creative with it. One is to extend the payment terms. So as you reduce it, they still get the same value, but it's just spread over a longer period of time. But at the end of the day, it's about if we don't have free cash flow to pay you, I'm not going to pay you and I don't want to be in breach. How can we figure that out? And having a very real conversation with people about it. Oftentimes, my students get concerned to talk about money. This is just a business, and this is measuring the risk of the business. And there's no guarantees in life, and the future is just a guess. And we're trying to build a construct that allows us to win as much as possible in the future. So what do we need to have? What needs to be true in our deal to make sure we both have the best possible outcome? and versus hardlining us with penalties and underperformance. Because after I've done deals pre-COVID and I've done deals after COVID, it's a lot easier dealing with practical, sensible, realistic views of the future versus 10-year expanding market, nothing's ever going down. The great question from Garrett saying, when would you do a stock deal versus asset? If I really like a company, again, I almost always do asset deals. I hardly ever do a stock deal. But where a stock deal becomes interesting is where you're acquiring into an entity that has significant brand equity or something that I'm trying to get. So the narrative behind a deal can be in many shapes and forms. It's not always easy to start from scratch. When you acquire the assets, you're putting it in an entity that's starting from scratch. It's credit history, it's bank accounts. So those need to be running for at least 6 months before you can really build off of it. Well, if you're starting something from scratch, so you're an acquisition entrepreneur, you might want to acquire the equity of a business that already has, a decade plus of pre-existing accounts, credit lines, things that are really beneficial for its ongoing operation. Then it makes a lot of sense. You also have buying entities, then wrapping the representations and warranties to protect yourself. Those become more complicated deals. They certainly exist, and you're capable of doing them, but I don't think that level of complexity makes a lot of sense sub 10 million of EBITDA. I try to be as simple as possible when looking at how this business is going to be operating moving forward and try to create a transaction that reflects that simple expectation. And the more things in it that I have to consider, the more expensive the deal is, but also how more complicated. The next question that we had is, do you ever revalue a deal based on due diligence? Yeah. In your LOI, the statement looks like this: subject to due diligence. Subject to due diligence. These are numbers provided based on what was provided by the seller, subject to due diligence. And you have to say, like, I'm going to probably have questions around this. We may have to figure out a gap between some things that you're saying and I'm saying, but we'll get there when we get into due diligence. I have more information that helps me focus that. Now, sometimes that leads to them getting more money. They missed a really meaningful add back. I'm pretty fair on that. I'll pay for the free cash flow. I'll pay for the earnings, and I'm willing to pay for it more if I'm getting the value. So, but they usually do. So everything that's in your LOI, just realize is going to change probably by the purchase agreement in some way, shape, or form. Robin, Sierra's our attorney, she doesn't like that as much. She tries to spend as much time making the LOI perfect as possible. But for small deals, for people who don't want to put that much upfront investment in accounting and due diligence, quality of earnings, a lot of that's deferred. And the delta is plus or minus 50,000, 100,000. It ends up not being that meaningful because they would have spent, a decent amount getting those numbers right in the beginning. So as long as you have a transparent conversation with the seller, they're usually flexible with you on that. But next question was, when do you negotiate seller salaries and compensation? Early on. So I teach vision casting, and in order for someone to sell you their business, they need to know what they make over a period of time compared to what they make running their own business. So say I run an agency and I make $200,000 a year. Great. And you're going to buy my agency from me. Okay. I want to make sure what I'm being paid as a salary and what I'm being paid out in distributions or consideration for my business makes me more money over that period of time, right? I'll defer, especially if my company is small and it's not worth that much, or I've been unsuccessful at selling it. I'll ride the growth of the business. But at the end of the day, I want to make more each year, the vast majority, than I'm making now. So I just always tell a seller, you're going to make per year almost what you've been making to date. My job is to pay you more so you can contribute more. Now, if they were taking out 500,000 in earnings a year for a 600,000 in revenue business, the math's probably not going to line up. There's going to be some normalization to that. But with the dividends or with the distributions or with the cash consideration, my goal is for them not to have a quality of life change. That's the big objective. You just have to make sure that the seller has a similar quality of life, that what their significant others expect them to make is what they make, if not more, and that the outcome is better for them and their families. So I know what that salary is before I present terms, because we do a whole call and we teach that call where we're walking through what the value of time is. And if you can make $100,000 or more, $200,000 or more than you're currently making for the next 5 years, that's salary plus distributions or consideration for the business. What's your life going to be like versus what you're just taking out now? It's being stuck at that ceiling, which a lot of sellers are. And so I make it as separated from the transaction as possible. Employment, I'm not a big fan of tying that to the actual purchase agreement. I like to say that's through an employment agreement. That gives me the freedom with the employment as a separate legal matter than the purchase agreement itself. The purchase agreement should be based around the performance of the assets I'm acquiring. You as an employee in our entity should be treated separately. And you can also build in incentive units, option plans, benefits, things that make the employment side a little bit different. And Garrett points out something that is very true. Counsel is going to advise, and so are brokers, that they want guaranteed payments. And the reason for that typically is brokers are only paid off of guaranteed payments. So if things are in the form of an earnout but not a guaranteed payment, brokers don't get a piece. So you can see why the seller's educated to have that as an expectation. You always have to think, who are their advisors? How are their advisors compensated? And how has that compensation and expectation made them the type of seller they are? And that could be an informed one or a not informed one. It could be dramatically left field ballpark expectations, unrealistic. But at the end of the day, it's highly tied to what they've been informed and told to. So our job is to educate them, know the market norms, know what's typical in the industry, and then educate them to that being the fact. So another great one is if we look at a note, if they weren't taking a salary and they were taking distributions, again, how they receive their earnings, how much they take home, you just got to work through. And the ideal scenario is for them not to be worse off than when they were making money from the business themselves. And if you can accomplish that, they're going to be pretty much fine with any way that you construct or form the deal. Another question about what do I look like? What does I typically look for in a CIM? So confidential information memorandum. And what are the things I really focus on in that deep dive call, second and third calls? A CIM is bullshit. A CIM is a marketing collateral teaser to make someone look at a prospective company. So I don't give a lot of attention to it. Show me a CIM that has a trend line going down, and then we can talk. I've not seen one. The vast majority of businesses that are represented by someone have a positive outlook being disposed upon them. So this is typical. So you just have to go into it knowing that this is a kind of like a starting offer. This is a rosy lens on the current performance, and then challenge it. The typical one I'm looking at is just historical trend of financial performance. If revenue's flat, if EBITDA is flat, but yet the next 5 years after I pay something for it, it's going to perform better, then that shows a seller and a broker running a process that isn't setting the right expectations. So I just focus on the trend, EBITDA growth trend, as well as revenue growth trend. Those are the things with the levers I can pull to speed up my return on this investment. Another good question, which was for financing deals, how do you know when it makes sense to do like an SBA financing deal or more upfront? So in service businesses, we have a few ways. There's hundreds of ways to structure a deal, and because of that, you can finance, you can creatively structure deals. the comment around seller financing or upfront or zero out of pocket, the current reference. I think it's always important to be creative with deals. One is I'm bored if deals are too straightforward. SBA is a government backed or government guaranteed portion of a bank loan. So someone else has to underwrite it. It's an incentive program for people to go out and buy established businesses, because in order for us to exist as a global economy, we're going to need to transition businesses to new owners and not just have them wind down and have a bunch of new startups all the time. So for us to be a global player, the government's incentivizing people to go out and buy companies, and they will then guarantee 70% of that amount. So banks can feel more comfortable lending to what could be deemed challenging businesses to lend to. Not too different than the schemes around student loans. And so when you look at creative deal structures versus SBA-backed deals, it's just adding a different criteria or qualification criteria to a deal. Also, there are ways around the personal guarantee. A lot of SBA deals require personal guarantee, but there's also ways around that. I'm not in favor of those, especially if you're just starting out in deals. Others promote it more, promote it much more than I do. I think in order for you to become a true deal person, you have to do a minimum of 5 deals. I find that people who do an SBA loan typically do 1 deal and operate it. And because the personal guarantee that many of them have to take on it, or because of the risks associated with it, they run that business and micromanage it. If you're a deal maker and you're really wanting to improve your ability to do M&A, you're going to want to have the flexibility and the freedom to do more deals. Seller finance deals allow you to do that. They don't have a lien on the assets. So a UCC1 lien on any assets from a seller note, which allows you to then put more debt or more seller notes in that business more freely. And you're less concerned relative to an SBA on its operation. If it doesn't work out, it doesn't work out. And there's ways to build in recourse for the seller if that's the case. So you feel more free to do other deals. Now, what does that mean? Well, if I think about wanting to pay more for a deal. Well, let's take a step back. Let's talk about those 5 deals. Imagine an oracle told you, the Oracle of Delphi told you that you are going to be a deal maker, and M&A is your key to generational wealth and success. And your life-changing transaction will happen after 5 deals. It'll be your 6th deal. But each deal you do has to get all your effort, all your time, as if it was going to be that life-changing deal, but they will all fail. This is a doom and gloom, but stick with me. So you are going to have 5 deals that you gave everything to, and none of them are going to work. But that 6th deal is going to change your life, change your family's life in the course of generations. Would you do the 5 deals? A lot of people don't. A lot of people don't have the fortitude to invest everything they can into a deal and have it fail and then continue to get up and do it again and again. And so realize deals are like this. So I always advise people to have the construct around a deal that gives them the ability to do more deals. And I tell that to sellers. I can't do a deal like this because it makes it challenging in my model to do the next deals. Now, one-off, buying a business that you want to run and operate, sure. Okay, all that aside. I'm talking programmatic M&A. I'm talking about building a system that allows you to acquire multiple companies into a single entity per year. So you need to have it supportive of it. You need to have the sellers understanding that expectation. You need to understand the vision that I'm casting here. Now, in this deal, what also made it unique, and I'll add this last bit for it because I got off a little bit. I see a double tap on the narrative. The narrative is really important. This was an Australian-based company, and the US platform that I have is run by an Australian. And some of the team is still in Australia. So I knew I Before I had that partnership in place, before I closed on that minority interest in that business, I didn't have a place for this seller. I liked the deal. I liked the EBITDA. I liked the potential. I liked the leader behind it, but I had nowhere to put it. Nowhere to put it. And then one of my partnerships closed, and I thought, perfect for that company. So the main takeaway that I often wish you all know and have is you have to talk to enough companies. You have to talk to enough people to figure out if the narrative is going to fit for you. And the first 1 or 2 to 20, 25 conversations you have, that narrative's not going to fit. You're going to have misaligned expectations from the seller. You're going to have people not really motivated to do a deal. Motivation is split into 2 words, motive and action. The reason, motive for action, has to be big enough, and the opportunity has to be a narrative that they can see themselves in. And when you spend that time and energy doing it, you'll be surprised how many deals you can get done. I'm reviewing one right now. Let me see if I can pull it up and walk through it with everyone. There's a current deal, and it came in through a broker. And by the way, although I am very critical of brokers, I do highly recommend that everyone continue to fill out CIM requests, NDA requests, and read about businesses that they're interested in acquiring. It's the best way for you to learn. And you'll see it. And I teach this in the course where I talk about the broker optimism being, in the CIM and what to look out for. But here's this business. So this is represented by Generational Equity. This agency here has, let's pull up their numbers and walk through it in real time. PR, a little more traditional, has been around for a while. Anytime I see iHeartRadio as one of the vendors, you know it's been a while. You know they're a little more traditional. And the org chart is, husband, wife, then children or team. And then I look at the salaries. So let's pull up when this year. Founded in 1993. This company was founded in 1993, located a little around Miami, doing PR, worked with great local brands, some good healthcare ones, vendors that helped them get their advertising out. Not the most creative stuff, very vanilla agency, but 30 years of history. 30 years. And this owner, let's pull up his age, 62, owns 100%. You're 62 years old. You've been running an agency for 30 years, and you've been stuck at around up plus or minus, $1 million and some change. And it's so hard. Public relations takes up 30% of the revenue. It's highly relationship-based, project-based engagements, nothing really retainer in that. And a bunch of other, complementary services that you can propose to PR type clients. Says they have 40 accounts. And you just look at this and think, how is this business acquirable? How can you really buy something like this without taking on too much risk and burden? So this is the landscape of a lot of businesses, everyone. You have 60-year-old owners in businesses for many, many decades at subscale, no real succession. I'm looking at the compensation of these businesses. And look like Garrett understands this, where I've got this from. Government contracts in it too, which are, again, relationship-based. And when you finally unpack it, you think, how would this person even wind down the business? Take that from a perspective for a second. You have a deal you're always thinking about acquiring, but if they don't do a deal, how would they wind down this company, right? Or are they going to die at their desk? And so this is the landscape of a lot of small businesses. If we don't figure out a way to free these businesses from their current constraint of ownership, we're going to lose these companies. Let's look at historical. So 2020, $1 million, 2021, 1.9, although there's PPP in that 2020. 2022, 2 million, 2023, 1.8, 2024, 1.2, and then it goes down. So the business is actually starting to decline. And it sounds like an owner who's really ready to move on. This is a good company if you're looking for some talent, if you want to transition those clients, but it's not at 62. If this seller is looking for a life-changing amount after working for 30 years, they're going to be sorely disappointed. So most of these deals will be in the form of I will pay you based upon your clients continuing to yield. And looking at the people, they're just north of Miami, but the creative director who's been with them since 1997 makes $70,000 a year. So you have to really then challenge the profitability of this business. Most of the team appears to be undercompensated, not market rates, or they're just not that good. So there's a lot to recast in this business. And of course, the forecasted performance shows it growing over the next 5 years under someone else's management. I'll put that into context. So most of these deals have risks of future expectations being realized. And my main thing when I hop on with these types of sellers, I say, the future is a guess. The expectations here, are you open to a deal that's creative that allows us to share that future expectation, uncertainty? And if they're not, you move on and say, let's keep in touch. But if so, 10, 20% cash on close is the most, the rest over some performance, or zero cash on close in many cases for very small businesses. And from there, normalize out here, there. For fair market value of the salary, $100,000 and $70,000 for the spouse who's working in the business, but they've been compensating themselves $150,000. No, they're just been, fair market has been underpaying them as a notation of EBITDA and underpaying all their people as well. So this company is not profitable. This company is actually not a good investment. And so they really need a partner who's going to help them build a plan to transition the responsibility of this asset to someone else. And that's very different than another type of acquisition or buy. I hope this was of value to you. I know I went over here a little bit, but let me know if you like these live AMAs, going through things in real time. I have them constantly, about 2 to 3 deals a week that I come across my desk that I have to review and I discuss. I'm very excited to do more of these at some regular cadence. Thank you for joining me live, and thank you for the participation. I hope this was valuable and provided great insights into these types of deals that are rapid. They're everywhere. 60-year-old owners, small deals who want to scale up and grow. That there's more deals like that than any other type of deal. So it's important that you remember that each deal is unique, and the key to success is going to have you talking to a lot of sellers and fitting the deal to the seller and your narrative. And you're going to understand that in pre-DD, due diligence, coming up with some strategic negotiation about the fit of that company and its future expectations, aligning these interests for your mutual growth. And if you have more questions, feel free to reach out. I'm happy to leave it in the comments to be of service. I will most likely host another one this month. And so if you want more details, subscribe at digitalagencybusiness.com, get my 21-day free email course, and join my newsletter. And you'll get more emails from me about these types of AMAs and other things that are happening within our industry. Thank you again, and we'll see you on the next one.